In Chapter 8 of The Intelligent Investor by Benjamin Graham, titled The Investor and Market Fluctuations, Graham introduces one of his most famous and influential analogies, Mr. Market. This chapter addresses how investors should view market volatility not as a threat or something to fear, but as an opportunity to make rational and strategic investment decisions. The key message is that investors must focus on the intrinsic value of their investments rather than be swayed by the emotional ups and downs of the stock market. The Mr. Market analogy. At the heart of Chapter 8 lies the Mr. Market parable, which is Graham's way of personifying the stock market. He presents Mr. Market as an emotionally erratic business partner who shows up every day offering to buy or sell shares at fluctuating prices. The important takeaway from the analogy is that Mr. Market is driven by emotions. Sometimes he's euphoric and offers wildly high prices, and at other times he's deeply pessimistic, offering to sell stocks at a discount. The beauty of this analogy is its simplicity. Graham wants investors to imagine that they are in a business partnership with Mr. Market, but to remember that they don't have to accept his offers every day. Investors can choose to take advantage of his emotional highs and lows, but they shouldn't let his mood swings influence their decision-making process. The true value of a stock is based on its underlying business performance and future earnings potential, not on the daily price quotes offered by Mr. Market. Graham explains that the intelligent investor will only deal with Mr. Market when it makes sense. This means buying shares when Mr. Market is overly pessimistic and selling when he's irrationally optimistic. The intelligent investor is not swayed by Mr. Market's daily moods, but remains focused on the intrinsic value of the underlying business. The investor uses market fluctuations to their advantage, making opportunistic decisions based on logic and analysis rather than emotion. Market fluctuations as opportunities. A key theme in this chapter is that market fluctuations should be viewed as opportunities, not threats. Graham emphasizes that price fluctuations in the stock market are inevitable and they are a natural part of investing. Rather than fearing volatility, the intelligent investor should embrace it as a tool to buy stocks at bargain prices when the market is down and to sell overvalued stocks when the market is up. One of the most important points Graham makes is that investors should not be concerned with the short-term movements of stock prices. These daily or weekly price changes are often the result of speculation, market sentiment, or temporary economic factors. They do not necessarily reflect the true value of a company. Therefore, investors should remain focused on the long-term fundamentals of the companies they own, rather than getting caught up in short-term price movements. Graham contrasts this approach with the behavior of speculators who often buy and sell based on market trends, rumors, or the hope of quick profits. Speculators are easily swayed by market sentiment and tend to overreact to price fluctuations, often making poor decisions as a result. The intelligent investor, on the other hand, stays grounded in the fundamentals, using market dips as opportunities to buy undervalued stocks and using market highs as opportunities to sell overpriced ones. The importance of intrinsic value. Graham repeatedly stresses the importance of intrinsic value in this chapter. The concept of intrinsic value is central to value investing and is a core theme throughout The Intelligent Investor. Intrinsic value refers to the true worth of a stock based on the performance and potential of the underlying business, rather than on market sentiment or price fluctuations. Graham argues that the intelligent investor should always base their decisions on the intrinsic value of a stock rather than on the current market price. Graham acknowledges that calculating intrinsic value is not always easy. It requires a deep understanding of a company's financials, including its earnings, assets, liabilities, and growth potential. However, the effort is well worth it, as it allows investors to make informed decisions based on logic rather than emotion. Once an investor has determined a stock's intrinsic value, they can then use market fluctuations to their advantage by buying when the stock is undervalued and selling when it is overvalued. One of the key takeaways from this chapter is that the intelligent investor should always have a margin of safety. The margin of safety is the difference between a stock's market price and its intrinsic value. Graham suggests that investors should only buy stocks when they are trading at a significant discount to their intrinsic value, as this provides a cushion against future market volatility. By maintaining a margin of safety, the intelligent investor reduces the risk of loss and increases the potential for profit. Patience and discipline. In addition to focusing on intrinsic value, Graham emphasizes the importance of patience and discipline in investing. The intelligent investor must be patient and willing to wait for the right opportunities to arise. This means being comfortable sitting on cash during periods when the market is overpriced and being ready to buy when the market offers undervalued stocks. Discipline is also essential, as it prevents investors from getting caught up in the emotional swings of the market. Graham warns that investors who lack discipline are more likely to make impulsive decisions based on fear or greed, which can lead to poor outcomes. By sticking to a well-thought-out investment plan based on intrinsic value and margin of safety, the intelligent investor can avoid these emotional pitfalls and achieve long-term success. One of the main reasons that patience and discipline are so important is that market fluctuations are unpredictable. No one can consistently predict when the market will go up or down, and trying to time the market is a dangerous game. Instead, Graham advises investors to maintain a long-term perspective, focusing on the overall performance of their portfolio rather than on short-term price movements. Dollar cost averaging. Graham also touches on the concept of dollar cost averaging in this chapter as a practical strategy for dealing with market fluctuations. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of the current market price. This strategy allows investors to gradually accumulate shares, buying more when prices are low and fewer when prices are high. Dollar cost averaging is particularly useful for investors who are concerned about market volatility but still want to participate in the stock market. By consistently investing over time, investors can reduce the impact of market fluctuations on their overall portfolio. This strategy also helps investors avoid the temptation to time the market, which is something Graham strongly advises against. While dollar cost averaging is a more passive strategy, it aligns well with Graham's philosophy of staying disciplined and focusing on the long term. It allows investors to take advantage of market dips by automatically purchasing more shares at lower prices, without having to constantly monitor the market or make emotional decisions based on short-term trends. The fallacy of forecasting. Graham is highly critical of market forecasts and predictions in this chapter. He argues that trying to predict the future direction of the stock market is a futile exercise, as no one can accurately forecast what the market will do in the short term. Investors who rely on market forecasts are likely to be disappointed, as these predictions are often wrong. Instead of attempting to predict the market, Graham advises investors to focus on what they can control, the quality of their investments and the price they pay for them. By selecting high-quality stocks that are trading below their intrinsic value and by maintaining a margin of safety, the intelligent investor can achieve success without relying on market forecasts. Graham also points out that the stock market is often influenced by factors that are impossible to predict, such as changes in investor sentiment, geopolitical events, or economic shocks. Rather than trying to anticipate these events, the intelligent investor should be prepared for the unexpected and should always maintain a long-term perspective. Chapter 8 of The Intelligent Investor is a foundational chapter that teaches investors how to navigate market fluctuations with confidence and discipline. Graham's Mr. Market analogy is a powerful tool for understanding the emotional nature of the stock market and for recognizing that market fluctuations present opportunities rather than threats. The key lessons from this chapter include the importance of focusing on intrinsic value, maintaining a margin of safety, and staying disciplined in the face of market volatility. By adopting a long-term perspective and avoiding emotional reactions to short-term price movements, the intelligent investor can use market fluctuations to their advantage, achieving superior returns over time. Graham's advice to embrace market volatility, rather than fear, it remains as relevant today as it was when the book was first published. For the intelligent investor, market fluctuations are not something to be avoided, but something to be welcomed, as they provide opportunities to buy low and sell high. By remaining patient, disciplined, and focused on intrinsic value, the intelligent investor can successfully navigate the unpredictable world of stock market investing.
Thank you for watching. Share this with friends and family, and please subscribe.
Of stock market investing.